Let's welcome in Siddhartha Bhaiya, Managing Director and Fund Manager at Aequitas Consultancy. Siddhartha, good afternoon. Great to have you with us here. Siddhartha is someone who, across schemes, his PMS, his AIF, his offshore fund, invests mostly in mid and small caps, and he's got a fantastic track record over the last 10 years or so. So he's made a lot of money for people who invested with him. So, of course, he likes the space, but maybe he does not like the space right now for the moment because of how well they've done. Am I sort of paraphrasing your thoughts correctly, Siddharth?
Perfectly well, Prashant. Hi, Prashant. Hi, Nigel. Surabhi, Reema. Good afternoon to you guys. I think, Nigel, Prashant, I've been in the markets for nearly 20 odd years. I've read history for more than 200 years. And trust me, what I see on the valuation front, I've never seen anything like this before. Or I've never read in history that valuations have been so high for such a long period of time. In history, you've had times where you've had bubbles where PE multiples have gone to 100, right, for a very short period of time, whether it was 99 or whether it was 2007 or even before that. But nothing like this, right? 50 and 100 PE multiples have become very, very common. So, yes. And as I said, we're all worried about one day, which is today, but look at what the indices have done in the last 6 months. The small cap index is up 30%.
Siddhartha, hi, good afternoon.
Hi,
fair enough. Your caution is well understood. So you really think that we in the mid caps and small caps are in a bubble zone? Are you steering clear then of this side of the market?
So I've always been a small and a mid cap investor, to be honest with you, right? And all I want to tell you is, say 3.5, 4 years back, it was a very narrow market where only maybe 15 or 20 stocks were doing well. And today you have a complete opposite where every junk stock is going up. You look at what is happening in the IPO market or in the SME market. So that kind of scares me. So yes, right now I'm worried, but this is my abode, So I've always been a small and a mid cap investor, and I'm always going to be that.
Hi, Sid. Good afternoon. I like the way you put it a few days ago. You said that management gives commentary and guidance for 2030, but the stock market wants to discount it on that day itself, and the stock goes rocket up. And today, in fact, some of that catch up is happening because people are a little bit cautious today. Maybe it's a few days phenomena, but there is clearly some kind of catch up. So tell us, what do you do then, Siddharth, from here? Now, I'm looking at some of your stocks. They've been big winners. Stocks like Apar, Power Mech, Technocraft, Jindal Saw, Jindal Stainless. These are 10 baggers, I think, in the last 4 years, most of them.
Yes.
So if we do see a correction, would you look to deploy in some of these holdings that you already have, or the buy stage is over? Now it's time to hold.
See, to be honest with you, these guys, these stocks have run up more than 10x, as you pointed out.
Yeah.
Right? They've been big contributors to our portfolio. So we would hold these stocks rather than buying at these levels. So clearly, I find very few stocks which are within our buying range right now. So we're holders. We believe, the infrastructure story is going to do well over the next 7 to 10 years. But do I see? As I said, I'm really worried about what is happening outside, in the broader market. And if there's a sell-off, then nothing is going to be spared. So yeah, I'll be cautious. I'll be very cautious as far as deploying money is concerned.
Currently, I think 5%.
So we're cautious as far as building portfolios is concerned as well.
All right. So that then 5% of your portfolio, I think, is in cash, right?
Yes.
So you won't be deploying that. But would you look to raise cash if you're going to be in for a rougher ride?
No. Again, as I said, Nigel, we are very long-term investors, right? We are more than happy to ride this correction. We could have taken a call for cash maybe 2 years back. And since then, our portfolio is up 300%. So we don't take very short-term calls. The valuations for our stock, see, we are value investors. So we still find that our valuations are not extremely frothy. Yes, they are outside our buying range because we want to buy stocks at single-digit PE multiples. But I don't see any reason to sell them. The long-term story as far as the sectors in which we are present is, it's kind of ironical that I'm saying, I see a lot of froth, but I don't see froth in my stocks, which probably every fund manager says. So, but that is what it is.
There is no stock in your portfolio, Siddharth, which you're tempted to sell?
Any stocks I've already sold, wherever I am.
So do you want to tell us the stocks which you've sold recently?
So we would have booked some in the top 5 names that you're looking at. We would have booked some profits over there.
Siddharth, what would the average PE of your portfolio be now? I mean, if that is a okay measure to look at?
Yes, so probably now on a forward basis would be something like 12 times earnings.
Oh, wow. Well, and that is serious stuff. So,
Again, as I said, Prashant, the lessons of valuations have been forgotten, and the markets are going to teach people some harsh lessons as far as valuations is concerned. I don't know when.
So 12 no, well put, 12%, 12 times 1 year forward.
FY25.
Of course,
FY25.
FY25, and you're someone who has a track record to maintain and uphold. So, and you're a value investor, but you like growth, right?
Yes, yes, obviously. Yeah. See, again, as I said,
yeah,
you look at these 5 names.
Yeah.
If you go back to, say, these stocks had not done anything from 2007 to 2020. In fact, a lot of these stocks had negative returns for a very long period of time. Completely ignored whether it is the cap goods sector, or whether it is the global commodities, or whether it is media. We've discussed media also before. So I think cycles last over decades. We're talking about, say companies in the B2B infrastructure lending, financial services. Nobody remembers an IDBI or an IFCI, or whether the erstwhile ICICI. So I think a lot of these, cycles will play out over the next 3, 4, 5 years. And the winners of the past will be forgotten. And cap goods is not a bad name anymore. But when we bought them in 2020, right, nobody even knew these names.
Yeah, Siddhartha, very, very true. New winners emerge in every boom cycle. But I must, completely with you on that. Nobody thought that capital goods will make the comeback that it really did. So let us ask you about this one question. Since this is a pocket that you have owned, you understand the valuation metrics as well. I think the problem that a lot of investors are grappling with now is that they understand the fundamentals are in place, and perhaps it is a multi-year cycle this time around. But how do you wrap your head around the valuations, because stocks have already run up? So what's a good PE to buy engineering or capital goods stocks at now?
So Surabhi, the day they get the quality tag and 100 P is acceptable is probably the time when everyone will enter this space. So I've seen these cycles, right? FMCG stocks used to quote at 10, 12 P multiple way back in 2004-05. And today they all quote at 100 P multiples. So you have to have a new breed of investors who at some point in time will come and say, oh, these are 100 P stocks and they should get 100 P. So we'll see. There is some way to go. Am I buying at these levels? Clearly not. Am I holding? Yes, I am. Because I see a lot of visibility over the next 3, 4, 5 years. Infrastructure is a need of the hour. It is not a luxury for our country, right? You look at telecom, you look at airports, you look at railways, you look at defense. We need that expenditure. And my sense is that the government is going to crowd out the consumer. So last 10 years were more about the consumer. Next 10 years is going to be about B2B investing. We're very bullish on manufacturing as well.
Okay, we have your top 5 holdings: Apar, Power Mech, Technocraft, Jindal Saw and Jindal Stainless. Do you want to go a little down the list, where in terms of your holdings, the stocks that you hold? Because we're very, interested. Your PE is only 12x. So do you want to tell us some more of your holdings? And when you booked out of these names, at least partial profit booking, what did you do with that money? Did you use it to up your cash levels to 5%? Or did you reinvest it? And if yes, in which names?
So Reema, something like Apar Industries have been holding for more than 10 years now. Whether it is Jindal Stainless, Jindal Saw, right? We are holding for more than 7, 8 years. So our holding periods are much Our focus is on getting the buying price right. Typically, we would want to buy stocks, very good companies and with good balance sheets when they're kind of, factoring bankruptcy. Like we bought a couple of print media companies a year back. And they were available with 50% net cash on the balance sheet and 3 and 4 P multiples. So that is again, people said, print media is a dying industry. And today we have the front 8 pages of any newspaper filled with advertisements, and most of it is IPO companies, which are, companies which are planning to come out with their IPOs. So I think what we want is industry leaders. We want them when they're completely ignored. We want them at bankruptcy valuations. And typically, and you kind of get it. Do you get it every day? No. Maybe you get it once in 6 months. But we are like Warren Buffett. We are ready to wait for the fat pitch or the full toss.
All right, Siddhartha, a lot of our viewers would like to know where you'll have gone ahead and increased stake, maybe a fresh entry in a particular company or doubled up on a position. So give us a couple of ideas.
So, as I said, in the last 1 year, we've increased we've added exposure to the media sector. We've also added financials for the first time, and we've looked at B2B financing, institutions which are focused on financing infrastructure and capex in the country. I leave that you and your viewers to figure that out. But yeah, and we're very selective, Nigel. We're very selective. We will not add more than 1 to 2 stocks per quarter. That's the maximum.
So, we had when you talk about manufacturing, right? The poster boy of manufacturing in more ways than one, because it has its hands in so many different businesses. Has been CG Power, right?
Yes.
Power, industrials, and others as well. But again, I mean, valuations are it's not palatable, I don't think. Just comment on that business,
Obviously.
if you will. I mean, it's a...
See, again, as I said, we've been fairly early investors in the power sector as well, whether it's cables, whether it is this. And some of the valuation, the stocks have run up quite a bit. Our thesis was the same, that for nearly 13 years, you had no investment as far as the power sector was concerned. The world spent nearly 5 trillion on renewable energy, and post-COVID, everybody fired up their thermal power plants. So India, I feel, again, as I said, I don't want to put out a very negative view as far as the Indian economy or this is concerned, right? We are in a sweet spot. If you look at any other economy in the world, whether it is the US, Europe, Middle East, China, I think we are better placed than anyone else. And we had manufacturing in India is going to do well, right? Today, I think there was some news around Foxconn that the Chinese government is investigating, a supplier of Foxconn for evasion of taxes. So people would, global companies would want to set manufacturing facilities in India. And I don't think so. It's going to be a bear market. But yes, there's going to be a correction as far as some of the valuations are concerned.
Siddharth, from micros and sectors, slightly pulling back to the macros.
Yes.
You like reading financial history, and you've looked at data going back 200 years, as you said, right? You've never seen valuations. As they say, right, interest rates act as the gravitational pull for valuations, right? Equity multiples. Yes. And as we speak, you've got the US 10-year, which is now topping 5%.
Yes.
Any thoughts on that if you want to weigh in at all?
I think Prashant, multiple times I've said, right, that from 1979, when the US Fed rate was at 12-13%, for a 35-year period, more than that actually, you had interest rates only go down. People have no idea about higher interest rates. And as interest rates went down, asset prices went up. And then you had unbridled money printing over the last decade. And that also led to, further increase in asset prices. So this is a bubble of epic proportions as far as valuations are concerned. I really don't know. Economically, we will do well, but I don't know when, how this corrects. But it is the correction. Financial markets are not about the last 10 years or the last 20 years. Financial markets are about 100 years, 300 years, 500 years. It is about human behavior, which doesn't change. So people haven't seen average interest rates in the US before 1979 have been north of 5.5%. This is the average interest rate. So why are we worried about a 5%? If you are a retired person, or if you are a person who's invested in fixed income, practically for the last 30-35 years, you've not earned anything on your fixed income portfolio. So naturally, even if you're a fixed income investor, you move towards riskier assets.
Yeah. So that a great conversation, and great to speak with you. It's refreshing to speak with you, because you kind of bring in the historical context as well, because I think that is sometimes missing in these conversations, but you brought it out very well. Thank you so much for joining us. And,
Thank you. Thanks a lot, guys. Bye-bye.
Thank you. Thanks very much. All right.